Hello guys, good morning, good afternoon, good evening, depending on where you are. Thank you so much for subscribing to this particular channel under CPA Makan from Kenya. I thank you so much for your support. I thank you so much for your encouragement. I thank you so much for viewing these particular videos that I've actually shared in that particular YouTube. I say thank you and thank you so much. Secondly, if you have not subscribed to my YouTube, kindly I welcome you to do the same. Do the same now so that you are able not to be left behind when the video is ready, when it is still hot and it is still interesting. So therefore I welcome you to ensure that your notification bell is on all the time so that you are able to learn more and more. Thirdly, if you want to support this particular channel, I also request that yes, you can do the same on 0735 So this particular contribution that you may be making will be going directly to supporting this particular channel to make it more effective and more elaborate and more helpful to you and to your friends. Therefore, welcome to this particular lesson today on Advanced Financial Management, August 2025 sitting. That is the examination sitting from KASNEB, correct? This is not the only unit I've done. I've also done several videos. One is at financial management under intermediary. I've also done financial reporting. I've also done advanced financial reporting. I've also done business mathematics and statistics. I've also done quantitative analysis. They are all in my YouTube. So therefore, kindly visit my YouTube, put your phone to the channel, ensure that you listen right away from the beginning to the end. Okay? So therefore, welcome to this particular lesson now. Good. Now, this particular question, I'm handling it right away from question 1 to question 5. So I begin from question 1B. Question 1B. I'm actually skipping theory part because I know I've covered comprehensively in my previous YouTube video. So kindly visit there and you'll be able to answer these particular questions that are there in the form of theory. So I'm handling specifically computation. Welcome and enjoy. Question 1B says, Ushindi Limited is considering the following projects. We have projects there, A, B, C, D, E. Initial outlay, we have in annual revenue, we have annual fixed cost, and we have project life. Additional information. 1. Variable costs are 40% of the annual revenue. 2. Each project is divisible. 3. Projects D and E are mutually exclusive. 4. Cash flows are confined within the lifetime of each project. 5. Cost of capital is 10%. 6. Ignore taxation and depreciation. 4. The company has a capital limitation of 400 million for investment. 8. All cash flows occur at anniversary dates. So therefore, these are very simple questions that we have been given and it carries 12 marks. This is from the topic of capital rationing. Capital rationing. So that is exactly where the topic where the question has been brought from, capital rationing. Now in this case, it means that the organization is facing some challenges. One of the challenges is that the organization has all the profitable or viable projects to be invested in. But the limiting factor in this case is that they don't have enough money to invest into these particular profitable projects. And therefore they are facing what they call capital rationing. So therefore they want to ration the capital, that is available so that they are able to only select those that are more better than others. So for that case, it is what they call capital what? Rationing. And you have been told from this question, the amount available is only 400 million. Now let's now identify what is very important. Number 1, we have been given the projects there, very important. Number 2, we have been given the initial outlay, that is the cost of investment. Number 3, we have been given there is annual revenue. This revenue has no deductions, so we need to affect on this particular revenue. Number 4, what we have been given is annual fixed cost. So we have the fixed cost the organization is incurring. Then we have the project life that we have been given, which is very important for discounting purposes. Additional information number 1 is about variable cost. So if you want now to come up with the gross profit, we need to factor in the variable cost. Then number 2 is each project is divisible. What does it mean? When you talk about divisible projects, we are talking about those projects that can start generating income or revenue even if they are not complete. They have not been completed. These are projects that you can start, and then you can, before you complete, you start getting the revenue. That is what you call what? Divisible. Therefore, it means that this particular project, even though you don't have enough money to undertake all of them, the partial investment that you may put into this particular project will be enough for it to generate some income. That's what it means by divisible projects. Then we have also been told that project D and E are mutually exclusive. These projects are mutually exclusive, means that these projects are independent. So they don't depend on one another. So by selecting one means there is a rejection of the other. For example, for this D and E, we will find out which one has the higher net present value. The one with the higher net present value will be selected. Then we eliminate the other. Then another element that is also very important is the cost of capital for discounting purposes. So let's work out. Question 1, Roman 1. Required optimal allocation of available capital to the project. Optimal allocation. So we can now go and work out on this. Now the first thing we need to note is that in this case we have the projects. So we have project A to E. So we can say we have E here. This is Roman 1. We have A. We have E here. We have D. We have C. We have B. We have A. So those are the projects that I have at the moment. Then I have the revenue here. Put your revenue here. So the revenue for A is 200,000. 200,000, which is 200 million, okay? 300,000, 1,515, 120, and 180. That is revenue. This is revenue before what? Then we have been told additional information number 1, variable costs are 40%. So we can say now variable cost, which is for 40% of this revenue here. So if you work out now 40% of the revenue we have been given, for that matter, 40% of the revenue that we have been given, you get now, here you will get 80, here you will get 120, here you will get 72, sorry, 72. 72. We have 68. We have that. So when you subtract now this, the answer you get is what you call contribution. So when you subtract this, you get your contribution. So this one you subtract, your answer you get is 120, 180, 108, 102, and 48. Okay? Once you are through with that, you bring in another expense called fixed cost. So you have your fixed cost here, which you have already been given from the question. The fixed cost for A is 50,000 or 50 million. We have 100 here. We have 60 here. We have 80 here. And we have 20 here. So the answer you get is what we call what? Operating profit. So we have now operating profit. Operating profits. So operating profit, this one will give you 70, this will give you 80, This will give you 48. This will give you 22. If I'm not wrong, will give you 22, and this one will give you 28. So that is your operating one profit. Now in this question we don't have any interest. That is true, but we have also been told from the question that we need to ignore taxation and depreciation. So therefore this one marks the end of that particular question. Okay, so we don't have any other thing to be done on this question. That is the end, because you have been told ignore the rest. So it will be like that. If we had interest or interest, we could have just put it here. Then depreciation we subtract also. Once we have done subtraction, we now calculate our tax. Once you are through with the tax, we now what you call net profit after tax. But now because this case here we are dealing with the cash flows, we add back our depreciation. Once we add back our depreciation, we arrive at what we call the cash flow. So here we subtract depreciation, then we will add back depreciation after providing for what? After providing for our taxes. So in this question you have been told there is no taxes and there is no depreciation. So that's what you have been told. On the same note also, we have also been told, given an information. The question is very clear. Roman 1 is saying optimal allocation of the available capital to the projects. So for us to find out the optimal allocation of this, we need to find out what we call what? A net present value. Net present value for each project. So you can work it the way it is by bringing here years here. Okay? Bringing years there. For example, in this case, you have been given years as, from the question, you have been given years as 3 years, 5 years, 4 years, 10 years, and 15 years. These years here will enable you to come up with what you call present value interest factor at the rate of 10% annuity. Now the letter A stands for annuity because it means that this amount of 70,000 is accumulative, not accumulative, sorry, it accrues every year for how many years? 3 years. 80 will accrue for 5 years, each year for 80, 80, 80. Then 48 also will accrue for 4 years. So 4 years, 4 years. So therefore we say annuity. And when you talk about annuity, I told you class that the formula to get the factor there will be 1 minus into brackets 1 plus r, our negative n, you divide everything by r. So in this case, you use your calculator very well, work out what is on the numerator first. Once you are through the numerator, you divide now with the denominator, so that now you get the present value factor to discount what? What are you discounting? To discount this net cash flows. These net cash flows. So if you press your calculator class, using that formula, you will get here 2.4869, 3.7908. This will give you 3.1699 and 6.1446, and finally 7.6061. Are you saying that, class? Then class, these factors you multiply by the cash flows, this line here. So therefore you get now what you call present value. So the present value is the factor times the cash flow, factor times the cash flow, factor times the cash flow, times factor by times the cash flow, and the answer you get is 174.08. This is 303.26. This will give you 152.15 and 135.18, and finally 212.97. So that is your present value. Now I want to find out the net present value. So remember the question was saying we want to calculate the optimal what? Optimal allocation of the available capital to the project. So we don't know how much to be used, but we have been given the amount as 400,000. Then you now net Once I have this one, I say less present value cash outflow. So the present value cash outflow is the initial investment given. For A is 100,000. For B is 300. For C is 150. For D is 120. For 120, and for the last one, E is 180. So when you subtract this class, your answer you get is what you call net present value. So net present value, now when you subtract this class, the answer you get here is 74.08. This is 3.26, and this one will give you 2.15, and this will give you 15.18, and this one will give you the figure to be 32.97. 32.97. Are you seeing that, class? So that is how you are supposed to do that. Now, because you are told that it's divisible projects, if the projects are divisible, then the correct method to do ranking is what you call profitability index. And therefore, I need to find out the profitability index for each of these. And before I do that, I was told that project D and E are what? Mutually exclusive. So from here, I can automatically say which one has the highest present value. Project E. So therefore, I will now say I will select this, but I will not select this one. So I will remove that. So when I will be doing my ranking, D is already out. So I will have A, B, C, and D. Therefore, let me work out. So let me calculate now the profitability index, which is given by net present value cash inflow, present value cash inflow divided by present value cash outflow. That is the formula for profitability index. Now, you take now the present value cash inflow. Where is it? So your present value cash inflow is this line here. Are you seeing this line? And the present value cash outflow is this line here, that row. So therefore, you work out now for this one, you now be 174.08. You divide by 100. You get the answer. This one is 303.26. Divide by 300. You get the answer. And this one will be 152.15. Divide by 150. You get the answer. This one will be 135.18. Divide by 120. You get the answer. This is 212.97. Divide by 180. You get the answer. Okay? Okay, class? Yes, you get the answer. So when you do now a profitability index using that, here you will get 1.7408. This one will give you 1.0109. This will give you 1.1265. This will give you this one is already I don't want D, right? So there is no need of D. So for the D, I don't need that. So I just need A, B, C. C is 1.0144. Then the last one here, I'm not doing anything here because I've already eliminated that. So the last one is giving me 1.1832. So those are my profitability index. Now I can give now the ranking here, rank, which is number 1. Now the one with the highest PI comes number 1. So which one has the highest PI? Which one has the highest PI? It is number 1. It is A. Second PI, it is B. This one here. The third PI is C. Where is your C, class? This one here. C. And this one is 4. So that is how you are supposed to rank. Now from here you have been told we don't have enough money. So I can now make conclusion by saying I have my projects here. Based on the ranking now, project A, I can have project E, I can have project C, and I can have project B. Are you seeing that? Now from here, project A, I need now to, what the amount I have initial outlay is what I'm very interested. The total amount for the outlay should be 400 million. So that is exactly what I have at the moment. Therefore, initial outlay for A is 100, correct? So initial outlay for A is 100. Then it will give me the net NPV. What is its NPV? If I invest the entire 100 million, I will get my NPV of 74.8. This NPV. So if I invest my 100, I will get the entire 74.08. Correct? Then project E, I will have to invest how much? 180. Correct? Is it 180 class? 180. Remember, the answer must give me 400,000. So if I invest 180 million, my net NPV is I'll get 3.26. Then E, C for that matter, where is C? How much is the total investment? The total investment for C is 150. But if you put here 150, it will surpass 400 million. So therefore, it will be this plus this is 280 from 400. What is the balance, class? 120. It means that for C, I will put 120 instead of what? Instead of 280. So for B, it will not be there, so that I get that figure. You get me, class? Then from here, if I want now to calculate to get my NPV, for this NPV of C, are you seeing C, class? This one here, 2.15. For me to get 2.15, I have to invest the entire how much? How much is that, class, for C? 150. Are you seeing that, class? If I invest 150, I will get this. But now this particular time, I'm not investing 150. I'm investing only what? 120. Therefore, it means this figure here, 2.15, will be a portion. Therefore, it will be 120 that I've invested over the total investment of 150. You multiply by 2.15, so that you get the correct NPV for that. So if you work out that question, the answer you get is 1 point. This one is get 1 point. This one was E. What was the net present value for E? This 32, sorry. See this C? This E here? 32.97. But this one will give you 1.72. Okay? So that now, from there, I have this. So when I add this, the answer I get is 108.77 million. That is how you are supposed to work out that question. So the question one was saying, Roman 1 was saying, optimal allocation of the available capital to the projects. Optimal allocation, I've done it here. Optimal allocation for Roman. This is Roman 1. Roman 1. Roman 2 is saying maximum resultant net NPV, net present value from the optimal allocation. Resultant net present value, which is this one here, I've done. So this is the answer for Roman 2. So I've worked out that question correctly. I go to question 2, class. I go to question 2 class. Question 2C. Question 2. Question 2C. So let's go there to question 2C class. A prime actual investors limited have the following portfolio of 4 risky assets and have deposited in a risk-free asset. The table shows portfolio weighting and the current asset returns together with their beta coefficients. We have the assets there listed as A to D. Then we have risk-free rate down the same, weighted average in percentage, current weighting percentage, current returns in percentage, and beta. Let me explain first what is the meaning of the word beta. When you talk about beta there, they are talking about the magnitude of risks. The magnitude of risks that these 4 projects are facing. So therefore, if you come across the word beta, we are actually referring to the risk volatility of the risks that we will incur when we will be now working on this particular projects. And therefore, we have those risks that are given, which are actually matched with what is current returns. Then you have also been told the overall return on the market portfolios of risky assets is 12%. So that is the market return portfolio. When we talk about a portfolio here, we are talking about collection of assets. If you have invested in various assets, it means that you have the portfolio. And the reason why you are investing in various assets is to ensure that you diversify risks. And therefore, this particular person is very wise enough that he has chosen 5 assets to be invested in, so that if one is faced with the higher risks, then the others will be faced with less risks. And that is why they are measured by what? Betas. But if you look at it carefully again, there is what is called risk-free asset. We have been given 30% for the weightings, and current returns at 8%, then beta 0. Meaning that these risk-free assets are not subjected to any risks. Why? Because these are guaranteed. When we talk about risk-free assets, these are purely assets from the government that have a guaranteed what? In rate of return. So you don't have any risk when you actually deal with the government. Let's work out the question. So compute the current return, compute the current return on the portfolio. Compute the current return on the portfolio. What is portfolio? Composition of assets. So we want us to calculate one figure for the current return for these assets we have been given A to B. And therefore our work is very simple. So we have been told to calculate the current returns. Current return portfolio. And we normally say for us to calculate current return portfolio, it will be the weighted average. It will be the weighted average. And class, when you talk about weighted average class, we are referring to addition. Weighted average. When it's a weighted difference, it will be subtraction. In this case, it is a weighted average. So we want now to find out the weighted average, which is now the probability times the returns, and for all the assets. So our work will be very simple. So we'd say it will be 18 times 0. That is 30% plus 20 times 15% is 0.15 plus 16 times 0.2 plus 10 times 0, 10 times 0.35 plus 8 times 0.3 equals to 17.5%. 2 marks. Simple like that. So current return portfolio is a weighted average. So weighted average for each. So this is asset A, asset B, asset C, and asset D. So 1, 2, 3, 4. Sorry, 5. Now we have an asset called risk-free. So if the question is asking the way it is saying, compute the current return on the portfolio, even that asset that does not have risk should be included in computation. Roman 2. Ascertain the beta value of the portfolio. So they want you to calculate the beta value. Beta value of portfolio. So beta value of portfolio is still a weighted average. Weighted average. Therefore, it will be probability that you are given there. You can see the probability, the percentage is there times the beta. For A, it will be 1.8 times 0.3 plus 2.2 times 0.15 plus 1.5 times 0.2 plus 1.2 times 0.3. Now they are saying beta. Then look at the risk-free rate there. It is 0. If it is 0, it will be 0. So we don't need to include it here. But you can still include, but it will be 0 because there is nothing you have there. So it will be 0 times 0 times, this is 35 times 0.3. So when you work, you see this one is no, there is no need of having this. But you can still include, but it is it because there is no anything that you will get from there once you invest. So when you work out that question, class, well, your answer you get is 1.59. So that is your beta. Roman 3, identify out of the 4 risky assets. So when they say out of the 4 risky assets, they are not referring to risk-free assets. They are only referring to A to D, from A to D. So you have been told from A to D, identify out of the 4 risky assets, the ones that are inefficient, efficient, and super efficient. So in this case now, we are going to compare the expected returns against the actual. Expected returns against the actual. Expected returns are actually given by what we call capital asset pricing model, capital asset KMPM. CMP, CPAM or CAPM, CAPM. So in this case, expected returns like a budget, what you are anticipating to have. What is the actual? Then compare with the actual to see whether you have insufficient, efficient, or super efficient. When you talk about efficient, it means that your projected value is lower than the actual. So you are earning more than what you projected. Efficient means, inefficient means it is less. And when you talk about sufficient, it means that there are sufficient means they are enough, you have gotten the profit, but inefficient means it is a loss. And when you talk about super means more, completely far from the expected. So therefore, in this case, our work is very simple. So we need to compare, we are going to compare the results from CAPM formula, which is risk-free. CAPM formula is given by expected returns for this particular case. So it can say now expected returns is given by risk-free plus into brackets class returns of the market minus risk-free times what? The beta of each given what? Asset. So we have assets A to D. Then we want to compare the results that we get here with the current what? Returns. Then we can make the comment. Okay, so let's see. For project A, you just substitute. Where is your risk-free rate class? Your risk-free rate is given, specifically from the question. They say risk-free rate of, we have weightings 30%, then current returns 8%. Then expected return is 8. So in this case, we can say for A, B, C, D. So it will be 8 plus 12 minus 8 times the beta of A. Beta of A is 1.8. Then still this one will be the same. 2.2. This one will be the same like this. 12 minus 8 into 1.5. Last one is 8 plus 12 minus 8 to 1.2. So what is the answers? What are the answers, class? So your answers are very simple. So here you will get 15%. This one will be 15.2%. This is 16.8%. This one is 14.0%. And finally 12.8%. Those are expected returns. What are the current returns? Go back to the table, class. The table you have been given here is 18%, 20%, 16%, 10%. That 8 is a risk-free rate, so which means we are not going to use. What is the comment, class? If the returns, if the current results are higher than the expected, it means what? You have done well. But if the current returns are less than expected, it means there is insufficient. So in this case, we had projected to have 12.2, but here we are getting 12. So therefore, it means this is what? Super efficient. This is super efficient. This is super efficient. Even this one is also still super efficient. Even this one is also super efficient. But this, the last one, you can see we had projected 12.8, but we got less. So this is inefficient. So that is how you are supposed to answer the question. Now, class, let's go to Roman 4. Roman 4 is saying, identify out of the 4. I've done that, Roman 4. Based on the findings in C, which is in C, this question is C, Roman 3 above, state the predictions that you would make regarding future asset values and their rates of returns. State the predictions. In this case, I can just predict by saying A, B, and C have super efficient returns, therefore expected to continue. However, D has inefficient, therefore management has to evaluate reasons why it is performing like that. Okay? Then the last one, Roman 5, it says, compute the equilibrium return on the portfolio assuming the weightings remain unchanged. Remember where the weightings are percentages will never change. Calculate the equilibrium. So calculate equilibrium is very easy. So they're just asking you, go to your returns formula, whereby saying risk-free plus into returns of the market minus risk-free, then you multiply by the overall beta. This formula for the whole now, what is the equilibrium? Equilibrium will be like this at a KPM point. So therefore it will be 8 plus 12 minus 8 into, so this one here, it is for the overall. Overall, in this case, we need to do something. We need to do something on the overall. We need to do something on the overall. Although we had already calculated, actually, we found something to the 1.5. You can see this overall better here. That is the overall one. So therefore this one will be 1.59. And your overall answer for that case (14.36). That is question 2. I go to question 4. You can see how simple questions they were. Good. Question 3 class. Question 3C. Question 3C is about international exchange, whereby we are dealing with exchange of currencies, whereby you are trading, you are buying goods and services from another country, whereby you are required to ensure that you convert your home currency into the currency of that particular what? Country. Into the currency of that particular country. And therefore, you have to convert it into exchange. So in this case, you have been told, suppose the pound sterling is bid at US dollars, 1 that in US, that, then that, and so that. Then question says, show the steps an astute trader would follow to earn riskless profits through a triangular arbitrage. So you have been told that use the triangular arbitrage to find out astute. Astute is a very smart business person who would take advantage of the currencies in the world to trade, to ensure that he or she gets what? Profit. In this case, you have been told 3. So when they say triangular, it means that there are 3 currencies we are using. The first currency is US dollars. Second one is pound sterling. Third one is euros from this particular question. Where do you begin from? You have been directed. You have been told, assume that the trader begins in the New York with the US dollars 10.50. Let me explain this information. Now, we can now say there is the first part which says interpret the information as it is. A is saying, suppose that the pound sterling is bid at US dollars, this pound sterling. So pound sterling is written as this way, like that. 1 sterling is given by 1.9 1.9822. Number Roman 2 that I'm seeing also there is euro. So 1 euro, just a minute. Sterling is not like this, sorry. The sign for sterling is just like that. But for the euro, it will be like that, which is given as 1 euro is given by, these are dollars. This one is 3570 dollars. Then the last one is in dollars. The last one is UK pounds. Pounds again, 1 UK pounds like this equals to 1.4582 euros. That is the information that is very important, and these are the steps. Now class, you have been told highlight the steps that you will use to ensure that to ensure that the trader gets what? A profit. So in this case, we just need to look at it and say, at the moment, step 1, convert dollars into into euros. I want to explain why. Class, listen to me carefully. Look at what I have already 10 million, 1,000, 1,050,000, right? Now, for me to trade, look at these figures here. Look at these figures. Which one is the lowest figure? Which one is the lowest? This is the lowest, right? It means that I have to buy this lowest dollar exchange so that when I either decide to go to the highest, second highest, or the highest, I'm able to get what? A gain. So look at this figure. This is the smallest one. So this smallest figure, I need to go and buy these currencies. So that now I will now sell to euros to get the profit, or I sell to dollars to get the profit. Therefore, it means my first step is to convert dollars into euros here. So that now once I get these dollars, once I get the euros, I will now come and buy the euros here. This is the second smallest, and this is the largest. So I now convert by saying 1 euro equals to $1.3517. What about $1050,000? Will give me how many euros? So it will be $1050,000 divided by $1.3517 multiplied by euros, and you get your answer. So when you do that, class, the answer you get for that case is 776,800 euros. So you have euros with you. The second step down is convert. Remember, I've explained by saying I have now converted, so I go and buy it and sell to this so that I get what? Profit. Convert euros to pounds. So I come and say 1 pound equals to 1.4582 euros. What about 776,800 euros? To give me how many what? Pounds. Okay? So when you work out this 776,800 euros, divide by 1.4582, you multiply by 1 pound, your answer you get, class, is 532,602 pounds. Okay? Finally, step 3, convert pounds into dollars. Correct? Pounds into dollars. Where is it, class? I'm now in the first one. 1 pound equals to 1.9822. What about, these are dollars? Okay. What about 532,602 pounds will give me how many? So it will be a multiplication. 532,602 times 1.9822. You get your dollars as how much, class? 1055,732. So when I go through the triangular arbitrage like this is the answer. Do I have a profit? Then the last one is compare. Compare Roman 3 and initial investment. How much was the initial investment, class? It was 1,050,000. So there is a profit. So a profit you have, because this one here is more than this, then it's a profit of how much? 1055,732 minus 50,000. So your profit there is $5,723. That is how you are supposed to work out that particular question. Simple like that. 6 marks. Simple marks. 6 marks. D. I'm going to question 3D. Question 3D. So question 3D is Renault Limited is engaged in plastic manufacture. It is now considering a new investment that would involve diversification into chemical manufacturing, where the business risk is very different from the plastic manufacturing. Research has produced the following information about the 3 companies currently engaged in chemicals manufacturing in the same part of the industry that Renault Limited is planning to invest. So we have the company there, we have equity beta, we have financed by, you can see the composition. Additional information 1, Renault Limited is financed by 60% equity capital and 40% debt capital, and would intend to maintain this same capital structure if the new capital investment is undertaken. 2, the risk-free rate of return is 5% and the return on the market is 9%. 3, the corporation tax is at the rate of 30%. 4, assume that the debt capital of Renault Limited and the companies XYZ is risk-free. Require Roman 1, calculate a suitable cost of equity for the proposed investment by Renault Limited in chemicals manufacturing. Calculate the suitable cost of equity. Now, suitable cost of equity. Cost of equity is given by risk-free plus returns of the market minus risk-free times what? The beta of the equity, or beta of ungeared. Beta of ungeared. Simple like that. Now, reason why I'm using this CPA formula is because I've been given the risk-free rate, I've been given returns of the market. So what comes in my mind automatically is a CPA. There is no any other formula that can fit in other than the CPA formula. So once I've written that formula like that, my work will be very easy. I go now and work out what is missing. Now from this question, we have been told that this particular Renault is moving from plastic manufacturing to chemicals manufacturing. Where this particular person is going has also some risks. And we have been given the risks in which the 3 companies are facing in the chemical manufacturing. So in this case now, it means that the Renault Limited is moving from his industry to another industry. Therefore, what I want to do now is to work out what they call beta ungeared. So I will do what they call ungearing and gearing. Why? Because ungearing means I'm now removing or factoring, or I'm removing actually the debts from the risks. From this particular case, I will now do what they call gearing, ungearing. It is the opposite of the what? Gearing, meaning you are removing what? Debts. And how do I remove debts, class? I have to remove debts by saying beta of ungeared is equals to beta levered over 1 plus into 1 minus t, then d over e. So, where t is tax, d is debt, and then e is what? Equity. So when I do this, you see, beta, I'm ungearing, which means I'm removing what? I'm removing debts in this formula, on this beta, in the risk, so that I get now the actual risk that is facing. So in this case, my work is very easy. Once I have the formula like this, look at what you have been given. You have been told equity beta, you have been listed down, then financed by. So beta liquid, beta levered, BL, beta levered here is purely this particular cost of equity ungeared, but it has what? A levered. So it is marked with that. So therefore, for project A, B, C, your work is very easy. So I will take for A. For A, it will be 1.33. You divide by 1 plus into brackets 1. Tax is how much, class? We have been told tax is at 30%. So you minus 0.3. What is the ratio? What is the ratio of A in terms of what? Debt and equity. You have been given already a composition of equity 40, but debt is what? 60. So it will be 60 or 0.6 divided by 0.4. You get the answer. B is the same. B is the same. You have been given 0.278 divided by 1 plus into 1 minus 0.3. Then debt for that Y. Actually, this is not A. This is Y. This is X, Y, and Z. That is how it is. Then Y is that you have been given is 25, 0.25 over 0.75. You get the answer. This one is 0.725 divided by 1 plus into 1 minus 0.3 into 0.2 over 0.8. Then you press your calculator. Very well, class. The answer you get there is very easy. This one is 0.6488. This one is 0.6324, and this one is 0.6170. That is how to get what? I've ungeared now. I've ungeared this composition. Once I've done this, class, I get the average of this. Okay? Get the average. So my average is now 0.6488 plus 0.6324 plus 0.6170. Then you divide this by 3. That is the average. So when you do the average, class, the answer you get there is 0.6327. Now, what have I done? I've ungeared, which means I've removed now what? I've removed the risky area. That is now the debts. From there, I will now return back. I will now do gearing. Gearing. I return this formula back. You can see this. I want now to return it back, which means in my formula here, I just need to find out the value of B, which means BL is now BU, which is better and geared, times the denominator is equals to what? So it is cross multiply. So therefore, in this case, it will be BL equals to better and geared into brackets 1 plus 1 minus T, then D over E. D over E, like that. Now, class, once I do this one, my work is very easy. Do I have BE? Yes, I have it already here. So it is what? 0.6327 into 1 plus, this one is 0.7 times. Now I'm ungearing this, right? So when I'm ungearing, to where? I'm ungearing now to find out the value for Reno. So the composition for Reno is now here, where I'm gearing now. Reno have been given debt to be 40 and equity to be 60. So this one is 0.4 over 0.6. So if you work out that question correctly, class, the answer you get is 0.97279. So that is the procedure. Procedure number 1, find the ungearing. Number 2, get the gearing. Gear, then ungear. Once you have done that, come and substitute in your formula, class, so that you get the correct answer. So cost of equity, risk-free, you have been told is how much? 5. Plus market returns 9. Minus 5. Better, which is now 0.9279. Then your answer is how much, class? 8.71%. So that is how you are supposed to work out C like that. Then the last part, which is Roman 2, is asking you, suggest a weighted average cost of capital that could be used to carry out an investment appraisal, NPV, of the proposed project. So calculate your weighted average cost of capital, which is given by cost of equity, weight of equity, plus cost of debt, weight of debt, then 1 minus T. Now, here we go to where are we now, class? We are dealing with who? With the Renault Limited. So therefore we go to Renault Limited. What is the cost of equity for that case? It is here. The ratios are here. So this 4 is debt and this one is equity. So it will be cost of equity. I've already calculated cost of equity, class, which is 8.71 times cost of weight times its weight of 0.4 plus the figure for weight cost of debt. Cost of debt, do I have it? Plus cost of debt. Do I have cost of debt, class? Yes, I've been given the cost of debt to be 5. So plus 5 times the weight, which is 0.6, but I'm paying tax 1 minus 0.3. So the answer I get there is 6.626%. So that is my weighted average of cost of capital that I can use for discounting. So weighted average cost of capital is cost of equity, like that. This one you did it in intermediary. Okay. Move on to question 4. Question 4, class B. Question 4B. This is about mergers and acquisition. Mergers and acquisition. So it states, KK Limited and JP Limited are companies operating in the same line of business. In the recent past, KK Limited has experienced very stiff competition from JP Limited, such that KK Limited is considering acquiring JP Limited in order to consolidate its market share. The following financial data is available about the two companies. You can see the annual sales there, net income there, outstanding number of shares. We have the earnings per share. We have also earnings per share market price. Then both companies are in the 30% income tax bracket. Roman 1, maximum exchange ratio that KK Limited should agree to if it expects to no dilution in its post-acquisition earnings per share, EPS. Now, class, it is very important you understand the question. They want you to calculate the maximum exchange ratio, and this maximum exchange ratio will not dilute what? Your EPS. So therefore, it means it is not that exchange, it is not the maximum, it's not the exchange ratio that they want. They want to maximum. So therefore, in this case, our work is very easy. For Roman 1, they want you to calculate the maximum exchange ratio that will not dilute what? EPS. So therefore, they are just saying, in simple terms, they are asking you, give us the exchange ratio using the EPS of the two companies. The logic here is, you take the ratio for the acquirer, you divide by the ratio of the acquirer, divide by the ratio of acquiree. So acquirer is the one that is buying, then acquiree is the target. So therefore, in this case, when they are saying like this, to avoid the EPS. And remember, just exchange ratio is just given by number of shares number of shares of what? Acquirer divided by the number of what? Shares of the target. Number of shares of target. So the target, the one, your shares, the acquirer, and the target acquiree. So in this case now your work is very easy. Your work is very easy. The number of shares of the acquirer over the target. But now the question is not talking about this. It is talking about the maximum exchange ratio to avoid what? Dilution of EPS. So it is not this formula now. So the formula that they want you to use is the maximum exchange ratio is given by EPS of acquirer Okay, in this case we are acquiring who? EPS of JP over EPS of KK. So that now the EPS for JP, from that statement as it is, the EPS is 2. So it will be 2 divided by 3. You are through already. Or you can put it in decimal. So if you put decimal, it will be 0. If you put it in decimal, it will be 0.6667. That is what they wanted you to do. Command 2. They are not talking about this. Command 2. KK post KK Limited's post acquisition EPS, assuming the companies agree on offer price of 45. Very simple work. KK's post, so when they want you to calculate the KK's post acquisition EPS, so EPS post acquisition. So we say now EPS post. How do you get it, class? Total earnings over total what? Shares. And I want you to see how I'm going to work out the total shares. Now we have been told that the JP has accepted 45 shillings market price against the market price of KK. So KK at the moment is 60 shillings, correct? But the JP is now, that's not, actually the market price for the JP at the moment is 30. But because it is being acquired, the value has gone up from 30 to 45. So therefore it means that is the ratio. That is where the ratio is. So in this case, I will now say total shares, total earnings for the two is 450 plus 60 divided by the number of shares, 154 KK plus, now the ratio here we have been told is 45 over what? 60. JP has accepted 45. So the ratio of what is being, the one acquired divided by what? The acquiree. So you can see it's 45 divided by 60. But how many shares were there in JP? 30 million. Correct? So that your answer is 510 divided by, if you work out this class, your answer you get is, you work out the denominator very well, your answer you get is 172.5 shares. So this gives me 2.95. So look at that. The EPS before acquisition for KK, it was 3. But now it has come down to 2.9. It means it has been diluted. Correct? Now next, KK's post-acquisition EPS. So they want you to, again, they are still dealing with KPA. Post-EPS, post, using this information now, post. You see this? The information is saying acquiring EPS, assuming that for every 600 ordinary shares of JP are exchanged for 10 units of 10 shillings, 10% debenture of 1,000 per share. Let me explain that. In this case, they are saying, in this question, they are saying that for every 600 ordinary shares of JP, you are exchanging it for 10 units of 10% debentures, which means you are not exchanging it for shares, but you are exchanging with the loan. So the shares are not changing. In this case, now we work out from there by saying 600,000 or 600 shares. 600 shares equals to 10 units of 10% debentures. Okay? Of each shillings 1,000. You can see the way they are saying. So therefore, that is JP. Then what about 30 million shares will be how many units? What is the interest? And what is the value? You can see that. Therefore, the number of ordinary shares will be 30 million up, divided by 600 times what? 10 units. Then from that, how many units are those, class? How many units are there, class? Then from there, I multiply each unit how much? 1,000? 1,000. Okay? So I will get now 500,000, 500 million. Without what? I've not factored in the interest. Correct? Now, this interest here is an expense to which company? It is an expense to the company JP. Therefore, it means that this 60,000 here, this 60 million will come down because of the figure of what? Interest. So let me calculate the interest now. My interest now will be 500 million times 10%, which gives me 50 million. 50 million. So it means this figure here will come down by 50 million. But it will not come down directly by 50 million because we have also the tax shield. So this figure here will attract tax shield. Tax shield. So therefore, it will be now 50 million times the tax shield. How much is this tax shield? What was the tax figure, class? It was 30%. So it means 30 minus 700 for 70. Like that. So your answer there should be 35 million. So this is the figure that should remain here, but not what? 30, but not that particular element. Now I'm through with that. So what was the question saying? Determine what? So calculate the EPS. So my EPS now, the correct EPS class is total earnings less interest divided by total what? Shares. This question, class, is very important because in this case we are going to say total earnings for KK is 450 plus 60, but this 60 is being affected by interest. You divide by how many shares? Remember, we are not using shares to buy the JP, but we are using what? The debt. So therefore, it means that the number of shares remaining here will be that of the acquirer, which is 150 million. Not this figure here. Why? Because we are not using the shares according to this question here. We are just using the shares to interchange what? To buy, to get the loan. So this is how you are supposed to work out. So your answer now, if if you use that question, the figure you get is 3.1667. That is the EPS. Then the last one, the reason why I'm not rubbing this is because of the last part that I wanted to use. So the last part of the question says, for operating profit. When they say operating profit, they are referring to EBIT, earnings before interest and tax. So you are required to calculate the EBIT of at a point of indifference between earnings of the firm under the financing plans in B Roman 1, Roman 2, and Roman 3. So Roman 2 and Roman 3. This information here. So you have been asked to calculate the EBIT. So in this case, that is earnings before tax and interest. Now, from the question here, we have just been given the net income, which means you have subtracted earnings, you have subtracted tax, you have subtracted interest. But for us to work out this question, you need to calculate the EBIT. And how do I get the EPS class? How do you get the EPS? Remember, Roman 1 and 2 are about the EPS. So in this case, I will now say for the EPS 1 using Roman 2. But I want now using Roman 2. In this case, it will be now is equals to earnings before interest and tax. I subtract what? Tax. Then I divide by what? Number of shares. Correct? Now from here, I have now EBIT is EBIT into 1 minus 0.3 divided by how many shares in Roman 2? 172.5 shares. So when I work out this one, it will give me what? 0.7 EBIT over 172.5 shares. This one is equation 1. That is how you are supposed to work out that question. Then you come to EPS 2, the same, which is now EBIT into 1 minus T over number of shares, which is the same as what class? EBIT into 1 minus 0.3 divided by how many shares? 150. So your answer here is at 0.7 EBIT over 150. This is Roman 2. So that is why I was saying I don't want to wrap Roman 1, Roman 2, and Roman 3 because it is very important. Now, once I'm through with that, your work is very easy now. Class, can you predict what is going to happen? Is to find the value of what? Is to find the value of EB? That is the question. That's what the question is asking, EBIT. Now, you can look at it and say now, say this and this are equal. So say EPS 1 equals to EPS 2. And you can equate the equation there by saying 0.7 EBIT over 172.5 shares equals to 0.7 EBIT divided by 150. Okay? Cross multiply, class, like that. So this times that, this times this, this times that. Then from there you collect the like terms and work out the value of x. So when you work out this, it will be 0.7 EBIT times 150 equals to 0.7 EBIT times 172.5 shares. Okay? Okay? Now, from here, if you work out this one will cross this side. Which one is smaller? Which one is smaller, class? So in this case now you'll have the EBIT. If you work out now the EBIT using the normal way, I've already simplified for you class. You can complete this. Then once you work out this one, your correct EBIT from this equation, just a minute. Yes. So your EBIT from once you have done this one, your answer you get there is very easy as 300. You get 3,000.33 million. So that is now your EBIT. So your EBIT at this point is this. Even at this point, this. So that is how you are supposed to work out that particular question. Then you go to Roman 4. Roman 4 is saying EPS at the point of indifference. What is this EPS at the point of indifference? Which means this information now here. What is the EPS? So your work is very simple. Pick any of the equation now. Any. You can use either the first equation or the second equation. So next I say EPS is given by 0.7. So I have now this one of 383.33 million divided by how many shares there? 172.5 shares. So you get the answer. The EPS there is EPS is 1.56. That is how you are supposed to work out that question. You can see how simple it was. So the issue here is, are you able to interpret EPS correctly? EPS is given by this one. You see me subtracting. I'm subtracting tax. It means there is no interest in that case. There is a mistake I've done, class. There is a mistake I've done. Sorry. There is a mistake I've done. Let me make some correction here. Class. Let me make some corrections, class. Now, here. Let me make some corrections, class, here. Now, for Roman 2, specifically Roman 2, there was an interest. This interest is paid from where? It is paid from the EBIT. So I say minus the interest of 10% of 500 what? Million. The answer I get, I now multiply with the tax. Are you seeing that, class? So therefore, when I simplify this equation here, it will be EBIT, okay, minus 50. Then you multiply everything by 0.7 divided by what? 150 million. Are you seeing that? Open the brackets here, class. Open the brackets. This gives you 0.7 EBIT minus this times this. Is it 35, class? Yes. Minus 35. This one. You divide by 150 million. So therefore, there's a problem here. One is 0.7 EBIT divided by 172.5 shares equals to 0.7 EBIT divided minus 35. Minus 35 divided by 150. Then this and that. So that this times this gives you what? 150 EBIT equals to this times this, which means 172.5 into EBIT minus 35. Then you work out the question, you will arrive at this question. Sorry for that. I'm going to the last question now, that is question 5. 5 is very easy question because it did not have much stories. So you are asked to the following statement of financial position and statement of profit and loss relate to Tola Limited for the year ended 31st December 20 what? For the 2023. So we have that question there. So we have been asked Roman 1, using the Spingate model, assess the financial health of the company. Assess the financial health. So Roman 1, using what? Spingate. Spingate model. To analyze what? Financial what? To analyze the financial health of this company. There are several models that have been developed to analyze the financial health of any organization. One of them, the Spingate model, which has 4 elements. Another one is called Altman's Z-score, which has 5 what? Elements. Then we have another one called X-score. X-score has 3 elements. So in this question, you have been asked to work out using what? Spingate. And this question again, it says that in this case for the Z, if Z is greater than, is less than 1, is greater than, less than 0.862, then Z is greater than 0.862. It means, this is the ruling. It means that if it is less than this one, the company is in financial distress. Financial distress. But if it is greater, the company is in financial what? Health. Financial good health. So if our Z will be less than this, the company is in financial distress. It is in bankrupt. It will not be able to meet the current what? Debts. Then Z, if it is greater than Z, then it is the company is financially sound. So it would be like that. Now you have been told to use that formula. So you have been told Z equals to 1.03A plus 3.07B plus 0.66C plus 0.4D. And you have been told A is calculated as net working capital divided by total assets. You can see that, class. Working capital, from you go to the question, how do you calculate working capital? Working capital is the difference between current assets and current liabilities. So from the question, current assets have been given, the current assets are 740,000 minus current liability of 600,000. Then total assets have been given, there is 221,40,000. So if you work out this question, it will give you 140,000 divided by 21,40,000. So what is your answer for? What is the value for A, class? The value for A is 0.06542. B, you have been told B is operating profit over total what? Assets. And when they of operating profit, they are also talking about what? EBIT over total what? Assets. So go to EBIT. The question for the EBIT there is 150,000 divided by the total assets, 140,000. So when you work out that, class, your answer is 0.07009. C is net profit. Net profit over total asset. Net profit there. Net profit before what? Tax. Before tax. before tax. Okay, so when you go to that point there, before you apply tax, I've been told it is 40. So you take now 40,000 divided by 2140,000. So your answer you get there for C is 0.06667. The last one, D, is you have been told sales. You take sales divided by total what? Assets. Total sales is how much? Total sales I see there is 600,000. Total assets there is still 2140. So the answer you get is 0.28037. Once you have this one, come and substitute your Z. You have been told your Z there is, your Z given there is 1.03 into A. A I have already as 0.06542 plus 3.07 B of 0.07009 plus C, which is, I've been given C there as 0.66 into C of 0.06667, then plus D, which is 0.4 into brackets D of 0.28037. Then when you work out that class, your Z value is 0.4387. So compare now, is it less? Because this figure, because 0.438 is less than 0.86. So the company is in what? Financial distress. Financial distress. It is not able to meet the obligations, both current and what? Long term. Both current and long term. Then Roman 2 there, on the same note, you have been told explain any of the two others. So we have now the second one, you can say Altman Z score. Altman Z score has 5 what? Has 5 elements. The first we have X1, X2, X3, and X4. Let me just explain very fast. Now, in this case, if Z is less than 1.86, the company is in financial what? Distress. But if Z is greater than 1.86, the company is financially healthy, financially stable. You can just say stable. It means it's able to meet what? The needs. Now for X here stands for what? X is a element, is a ratio where we have the working capital divided by total assets. This one is retained earnings divided by total what? Assets. This one is earnings before interest and tax divided by total what? Assets. Then X5 is market value of equity, market value of shares divided by total liabilities. And then the last X5 is sales divided by total what? Assets. So class, examiner might give you this particular question. Use Z score to analyze. So you have to know how to calculate X1, X2, X3, X4, and X. Then ensure that you know how to make what? Decisions. So I'm going to the last one. That is how you are supposed to answer that question. There is another one called X what? Score. X score also is also a very important element. It has 3 elements only. So let me go to the last one. B. So our B is very important. So what have I said, class? I've said we have the Spingett model. Ensure that you know that. Then number 2, you have the Z score model. Ensure that you know. Number 3, you know what we call what? X score model. Go back to my notes and you will be able to find out this. So let me go to the last one. That is B, question 5B. Mark Otieno, who trades in shares at the Securities Exchange in the spot market, values the rule when prices are rising, buy. When prices are falling, sell. He ensures that this portfolio is intact and at the end of every 3 months. He has basic understanding that buy equates to call option and sell equates to put option. For a 3-month period, he carried out trade in 5 listed companies as shown below. You can see the listed companies there. We have the companies, we have the spot price, we have 3-month expected prices, then we have exercise price. Let me explain some few things before I work out this. Now we need to know what is a call option. Call option is an option, is a right. Is a right to buy. A right to buy with what? With the expectation of price to rise. Therefore, it means if we enter into a contract and we found that the price that we sealed at the beginning, which we call it exercise price or strike price, is less than the spot price at the time we are exercising this contract is higher, then we have a profit. Because it is this way. If we have entered into a contract to sell an asset at 40 shillings, then the spot price, that's at the time, that is in the future, it is 45 shillings. Okay? So what does it mean? We will buy at 40 and we will sell at 45. So there is a profit. And therefore, for us to calculate this profit, we need to take spot. Another word for spot is exercise price. You minus the excise. Spot. Another word for spot is market price minus the excise price, which is also called what? Spot. It's called not spot, but it's called strike. So, if the one we signed into the contract is less than the current market price, which is spot price, then we have made a profit. But if it will be less, we have made a loss. Another one is what we call put option. Put option is the right to sell. You sell because you anticipate that the prices will come down. If the prices will really come down, then you have benefited. You have a profit. Therefore, in this case, your formula will be the opposite of this. Exercise price minus spot. And the exercise price is also called what? It's also called what? Strike price, spot price, or market price. So that's what we have been told here. Then you have been told, Roman 1, compute the prices of the shares and indicate the option chosen in each of the 5 companies. Compute the prices of the shares and indicate the option chosen. Which option was chosen? Now let's see. We have the company here. The company is called Safari Land. Then in 3 months, we are expecting it to grow up, which is by 20, which is 1.2 times 445. What is the price? 3 months time. Then we have the excise price. Then say option. Which option are you choosing? Then we have the APSA Land is again going up 1.5 times 414. Then we have CICD. It is coming down, which is 0.9 times 395. Then we have Jubilant. Jubilar, it is increasing 1.05 times 380. Then we have the last one, KCIQ, which is now decreasing by 15, which is 85 times 405 in 3 months' time. So in 3 months' time, class, this one will be 554. This one will be 477.25. This one will be 355.5. This one will be 399.399, and this one will be 344.25. You can see that. So once you have this, compare with the exercise price now. Here is 470. This one is 450. This one is 370. This one is 390. And this one is 395. So in this case, the question is that, so you have been asked compute the price of the shares and indicate the option. So compute the price of shares. I've done already computation of the prices. These ones here. Okay. Then and then indicate the option. So in this one now, what is the option here? Now remember, if the exercise price is, that is what we signed. Now it is 554. So let me see the last one. Using appropriate computations, determine the gain or loss in each of the tradings in the above company. So it means the question wanted only be to stop there. Then I now come and work out so I can now say companies here. Okay, companies, I have it there. There are 4. So I have now the 3 months price for companies there. Companies, I think I just need to. So my work is very easy there. I have already the prices here. So what I need to do, I need now to compare, to extract, to subtract. Now, for example, now, what type of option is this, class? What type of option is this? This one is, should you buy or sell? Now, it is against, you measure actually against the, before that, let me say this exercise price here. Exercise. So this one was 470. This one is 450. This one is 370. This is 390. And this is 395. Now, what is the type of option? This is what now, class? You can see. So, this is so in 3 months' time, it will be this. So, what is that? This is a call. This is call. This is call. This is call. This is put. And this is put. Call. Put. Put is to do what, class? Let's understand. Call is to buy. Now, in this case, in 3 times, in 3 years, it will be 554. Then you sign the contract now of 470. Now, in this case, will it be very favorable? In the books, I've put it, if it is to call, you see it has increased. You see, the one that you have put in the contract is 470. But the market, the spot price at that particular time is 550, for it has risen. So you can say there is rise. Now look at this one. Now it is we signed 450, but it's now 477. So it is rising. It is a call. Now in this case, you can see we have signed a contract of 370, but in 3 months' time, it has come down. What do? You sell. So it is falling. This one is rising. This is falling. That is why it's like that. Then the last part is very easy. The last part is very easy. Once we have now put our information the way it is, we now say company 1, 2, and 5 and 3 are to call. Now for the call, we say it is a spot minus excise. Right? Now for company 1, spot, that is the current now, it is 555 minus the excise, which is 470. We have a profit. Correct? The same applies to Safari and Jubilee. Now when you go to put, it will be excise minus spot. So that now you get the profit on this area. So it will be, for example, put is this. So I have now 370 minus 355.5. So this is how you are supposed to work out this particular question. So you can see it was so easy, and you are supposed to score everything from this particular question. So we have revised right away from question 1 to question 5. If you have any question, class, try to reach out to us on 0735 346 777 for more clarification on the same question. Thank you so much, and have a wonderful time, and I wish you well as you continue with your revision for the KASNEB.